Good morning. Morning, everyone. Welcome to another Wealth Coffee Chat. Good to see you guys up and early and at it. Early bird catches the worm and all that sort of thing. Hey, morning, crew. Rob, Luke. Morning from Mansfield. What are you doing in Mansfield, Luke? Or is that where you reside? Great to have you guys on the live stream this morning. Fantastic day. Thankful Thursday. Morning and windy. Rainy Melbourne. Oh, well, there you go. Jason Witten's my name. Some of you already know that. Do the intros. Morning, Doug and Donna and Margaret. Checking out your two new bills. Nice, man. Nice. If you don't already know, there's my name down there. If you're new, give us a shout out. Say hello. You might be new to one of our mentoring and coaching programs. We have coached property investors. Now we're entering our 20th year. 20th year this year. Coming. Helping property investors across Australia and New Zealand buy real estate. Over 10,000 properties our investors own that we help them manage, maintain, maximise, acquire, and in property investing, well over 22 years myself. Hey, Brennan, good to see you, mate. Thanks for joining me on the show. Brennan's one of our team. Been working with Brennan for over 15 years. Coming your way, Brennan, coming your way. So, listen, folks, who doesn't like the idea of saving a bit of tax? It's our number one expense as investors or as participants in the economic system that we choose to participate in. Maybe not a choice, but we're in it. We're in the Australian economic system. We're in the tax system. We are registered tax-paying entities according to the government, and they want their fair share. And I think not necessarily a fair share, personally, but just between you and me, about the efforts, the output that we have, and about, the money we make and the tax that they want to take from it. For you and me, for smart people, we need to manage and understand how we can minimise our taxes as we go along in life. And there are a number of ways to do that. Very legal, boo to capital gains tax as well. Very legal, rule-following, ridgy-didge ways of managing your tax affairs, tax minimising, tax planning, because that's what smart, wealthy people do. So today I want to talk about one of those ideas. But, you guys have heard me talk about this before. There are a number of places that we can have some tax-free benefits in and how we hold real estate, right? So there's three main ones. And if you're a business owner, there's a fourth one. But tell me in the chat, folks, what are the tax-free places and spaces that we can own assets, or the assets that can be tax-free or minimize our tax when we get into owning stuff, folks, owning stuff. Put that one in the chat for me. Tell me, what are they? What are the main places or things that we can do when it comes to tax-free? The first one, the easy one. Yep, Nintendo's jumping straight onto it. But the easy one, the no-brainer. Let me put this right here. The first one, no-brainer, easy one. We've talked about this before. Your principal place of residence, folks. Your principal place of residence. The home you own is tax-free, right? Capital gains tax-free anyway, tax-free, CGT. Now, for many of us, we must understand, or we must think about the idea of upgrading our principal place of residence many times over our lifetime. Many is not a good description. I would encourage you to upgrade your principal place of residence at least 2 to 3 times, each time maximising the that tax-free threshold by buying and selling a principal place of residence. Now, you either buy and sell or you physically upgrade, like knock down and rebuild. Now, that's not what today's conversation is about. We're going to sort of do something else today. The other place or space. Now, tell me in the chat while we're sitting here, the other one is yes. It's not necessarily self-managed super, Nick and Nintendo, but we all know what you're saying there. It's just super, okay? Now, for your principal place of residence, it is unlimited, folks. Unlimited. Unlimited value, tax-free, capital gains tax-free value for a principal place of residence, okay? So there's no limit. If your home's worth $100 million and you sold it and you didn't have any debt on it, it's a tax-free gain, right? A lot of people sort of miss that in their wealth creation strategy, and we don't. The place to own some real estate or own some assets that it doesn't matter whether it's real estate or not, is your super. Tell me the number. How much tax-free assets, value of tax-free assets, can you own in your super? All right. What is the threshold at this moment in time for an individual? What is the threshold, folks? What's the threshold? Tell me that in the chat, and I'll give you a hint. It's something, right? Here we go. Boom, Nintendo was on it. $1.7 million. $1 million, like, okay. So that is what we're going to talk about today. 1.7. Nick, it went up from 1.6 to 1.7, and it's going to continue to go up, folks, for the foreseeable future. It is indexed with inflation and all sorts of stuff. That is why I think it's valuable. Now, you don't want to go too early on this one, but let me talk to you about the other place we can have tax-free value and gains. Obviously, when you have investment properties, okay, you can decrease your income tax by using depreciation plus costs to offset, using the concept of negative gearing at this moment in time. Now, many of our investors have in the single digits tax returns or tax numbers. And the fourth one, for business owners, if you qualify, what can you sell your business for tax-free into the future, folks? If you would, and this is the problem, and I'm actually doing a program on this for business owners real soon, so I'll let you guys know what that's about. But what is the value if your business was worth something and you could sell it? What capital gains tax-free value per shareholder? Nintendo is on it. Been watching my shows often. $2 million per shareholder, by the way, per shareholder. So if you've got 2 or 3 or 4 shareholders, that is $2 million each, right? $2 million each, tax-free. Tax-free if you qualify and you're structured correctly in the future, okay? Yep, it's $2 million. Right, so today we're going to talk about this one because, this one concerns me, and it should concern you as well. Anyone seen this of recent times, all right? The 5 super funds representing 600,000 members, $27.8 billion have failed. I'll say that again, failed, folks. Oh, my little highlighter doesn't work very well there. Failed. No, it's not working. Right, failed. The regulator's performance test. Check that out, right? This for me, for all of us, really, for me, just demonstrates how many of us don't think about super being our money, our wealth. It is 10% of everything you earn, or up to a certain threshold, $27,500, folks. 10% of it goes into your super. 10% of your life. You think about this. As a week, that's half a day. That's half a day every week goes to your super, and it's failed the regulation performance test, right? And, some of the challenges, and you have a look at this. This is some recent stats came out in the ABS, the Australian Bureau of Statistics. Look at this. Look at this. You go ahead and let's say you start work at, let's call it 25. 25 is the number. 25 and you work to 65, right? 25 to 65. Like that's your proper working life, okay? 40 years. 40 years of working, and the average person, and this is, let's look at this at sort of retirement. Yep. Hey, Jace, how are you, mate? Good to see you. Listen, 40 years of working, and the average male has 175, and the average female, call it, let's just be conservative and call it 140. 140. Who, like, does that, now what is the gap there? Call it, like, have a look at the gap of tax-free gap, right? Tax-free gap. You work all this time, you're going to earn some money, you're going to do something, and the gap between the amount of money creating assets out of your super and what you could have in your super, have a look at that. It's like, call it like 1.5, 1.4 to 1.5, mil of tax-free opportunity left on the table, right? So how do we, folks, get more value, more understanding, more concentration of our wealth into that place and space, all right? Because for all of us, this game is a game of maximizing our wealth from every opportunity we can. If you own assets in your super in retirement, they are approximately 30% more efficient. Why are they 30% more efficient? Because if you were earning, let's say, $100,000 outside of your super in retirement, you would pay 30% tax on that. But inside, you're going to pay zero or approximately that amount, right? So for all of us, where we sit right now, what trajectory are you on? Where are you at? Where are you at? What age? What age are you at? And what's your balance? What's your dollar balance now? And do you have a plan to make sure you take advantage of this gap of wealth, right? This gap of wealth. This also came out in the recent, or one of the recent data collections, right? Check this out. This is the median wage, right? Or the median taxable income. So, have a think about that. If you're on $60,000 or $70,000 a year, there is very little hope that you can contribute over and above your minimum contributions from your employer into your super, right? Okay, difficult. Okay, well, let's talk about possible opportunities here. Here's some possible opportunities over a period of time. Okay, over a period of time, there's a few things that you can do, right? So when you're closer to an age of some description, when you're closer to an age of some description, you guys know what do I say all the time? Buy well, never sell, right? Never sell. Now, I will allow that rule for me to be a little flexible to do this, right? So here's one strategy I'll share with you guys today, and I'll get my good friend Andy Fenton to share a few other strategies. If you're interested, tell me if you're interested in the chat. Would you guys be interested in doing a full breakdown on this one? for how can you have plans to get a value into your self-managed super or any super, by the way, by the age of 65. Close that gap. Buy well, strategically sell. I like that. I like that, Hardik. I like that, Hardik. So there's a certain time. Let's say over here in our world, you guys have seen this before in our acquisition phase, right? Acquisition. We buy some real estate. Terrible pieces of drawing here, but here we go. Let's say we buy our investments. We're traveling along as we go. We identify one of these to strategically sell. Nice. Yeah, that's awesome. We identify this one's to strategically sell. Let's say you bought it for $500K. Now it's worth $1 million. $1 million over here. All right. You can, at the right time, this has to be the right timing, you could sell this and the proceeds of it can be transferred into your, let's say, a better place. Let's say your super. Oh, that red's terrible, isn't it? Into your super, tax-free. A certain amount, up to $500K, or it depends on the rules, right? Okay, that's one way you can do it. You choose one of your properties that you would strategically sell and roll the value of that over into your super into the future. Now, if you had a partner, you and your partner, wife, husband, whatever, then you would choose two of them, okay? One for you, one for them. And you'd roll it over because the 1.7 adds together, right, to become 3.4 for a couple, right, for two people, okay? So that's huge, 3.4 mil, tax-free, income tax-free, capital gains tax-free, folks, as you go along. I'm a big fan of owning some real estate with your super fund anyway. I've done it. Many of my clients do it. Check with your financial planner if it's appropriate for you. But it's fantastic. I love it. What's another way we can do this? If you're a business owner, this can be a commercial property, folks. Commercial property. And commercial property works extremely well, team, for your super if you're a business owner, okay? And or for the capital gains tax-free $2 million thing as well. So anyway, does that make sense? Where are your assets stored now? Okay, where are they stored now? It's appropriate and efficient and easier to buy in your personal name, all right? So for most of you, you're buying in your personal name between you and your partner, you and your investment partner, could be life partner too. Company and trusts can work for business owners, but really buy and hold property investors, not so much. It's not as good. And then what strategically will you do to make these more efficient into the future? Okay, how do we do it? Okay, what do we do as we go along? Because then we can transfer them into other places which have some efficiencies for that process. You guys know this. We call that consolidation. This is kind of lifestyle and legacy as we go along. All right. I think that's about it for today. Fenton's on a holiday. Andy Fenton is on holidays at the moment, so we might hit Fenton up for a little bit more action and conversation. But we've done a few videos on that for you guys at our mentoring program. So if you're in our mentoring, go check that one out as well, which is good. Hardik, probably around that. It's usually an age thing. Hardik, rather than a stage. But usually it's either consolidation moving into lifestyle. That's usually when the timing's right, when you've got enough equity in that property, rollover value. There's an age where there's a certain age from 55 onwards where you've got like this extra contribution you can, lump into there. And there's also a downsizer contribution, folks. So further down here, if and when you sell your principal place of residence, folks, if you sell your principal place of residence, there's actually a downsizer contribution as well. So there's a few strategies, which is kind of cool. Anyway, there you go. Hey, Bob, we're not doing Wine and Wisdom, Wealth, Wine and Wisdom. Andy's on holidays, but we will be back to it next week, Bob, next week. So stick around for that one, folks. All right, then. You guys be awesome, be well. Wealth Coffee Chat done and dusted for today. Join me tomorrow for another one if you're up for it. And you guys be well. And then, see you tomorrow. All right, folks. Adios. Bye for now. Rose. Depends on your age, Rose. Depends on your age, okay? But, hey, thanks, Dion. Thanks, Hardik. Thanks, everyone. Bye now. Thanks, Shelley. Hey, Shelley, we got to catch up. We should do that today. Bye-bye. 57. Yes, Rose, you should reach out to the financial planners. Connect with your coach and then get a meeting with the financial planner. All right, team.